Welcome to learning objective number 3. In learning objective number 3, we're going to look at understanding how T accounts and debits and credits are used in the dual entry accounting system. So what does this all mean? Well, this is our system of coding up the recording of different accounting transactions so they can enter the accounting system. We can then consolidate that information together to generate financial statements. So let's start with this slide and let's have a look at a T account. So basically what a T account is a convention and a device to accumulate information about transactions that are affecting each individual account. So for every single account, we have a T account, and every single transaction that affects that T account is recorded in that T account, right? So we have a T account for all our asset accounts, all our liability accounts, all our equity accounts, okay? And remember that obviously if you add up the balances of all the asset accounts, they will equal the total balances for all the liability and equity accounts that we have. Now, there's a naming convention within this process that we refer to increases and decreases in particular accounts. And this convention relates to debits and credits. So, what are debits and credits? Well, this depends on the nature of the account we are specifically looking at, right? So, debits are what we refer to as increases to asset accounts. So if we debit an asset account, we are increasing that asset account. If we debit a liability account, we are decreasing the liability account. And if we debit an equity account, we are decreasing shareholders' equity, right? So we're decreasing the value of that equity for the owners in the business. Now, vice versa, a credit will decrease an asset because debits increase an asset, so credits will decrease it. Now, for liabilities and equity accounts, a credit increases the liability account and it increases the value of shareholders' equity. Now, some of you are probably sitting there and thinking, well, how do I remember all this? This is just debits and credits. Why don't we just refer to it as increases and decreases? So this is the terminology of how we record accounting transactions, and this is probably the most important part of what you need to learn in today's workshop. You need to understand how debits and credits affect different accounts. Now, I asked you earlier in this workshop to write out the accounting equation on a piece of paper. And there's our piece of paper right there, right? So I asked you to write out assets equal liabilities plus equity. Now, the easiest way to remember how debits and credits affect the accounting equation is to write for assets, assets are increased by debits and decreased by credits. Liabilities and equity are increased by credits and decreased by debits. Now, as you can see here, if we are using the debit and credit terminology to refer to accounting transactions and whether or not we are increasing and decreasing accounts, every single transaction that we record needs to have a matching debit and credit effect for our accounting equation to stay in balance. Now, I want you on your sheet of paper right now where you have your accounting equation written out to make sure you note on here, debits increase assets, credits increase liabilities and equity. And then underneath that, credits decrease assets and debits decrease liabilities and equity. I want you to do that right now. Have you done it? Now, some of you might be wondering, well, why did I have to just do this? Why did I write it out? Well, you need to write out so you can remember it. Now, is there a reason why we use debits to increase and credits to increase? Well, not really. It's an accounting convention that you need to remember. It's just like if you drive on the road, you need to remember, in Australia at least, and other countries, Caribbean and India, South Africa, Japan, and some parts of Europe, so Cyprus, Ireland, Malta, and the United Kingdom, that you need to drive on the left-hand side of the road. That is the convention. You need to remember it. So if you drive on the right-hand side of the road in Australia, you'll be fine. And if you don't use the correct debits and credits when recording transactions in this subject, then you are obviously going to lose marks and your grade is not going to be as good. So it's something that you need to remember, which is why I emphasize, make sure that you write it down on your piece of paper right now, how the debits and credits affect the different types of accounts. Now, here's a piece of music. Again, as I mentioned over the last few weeks, how do you best learn accounting? You learn accounting through practice. The more practice you do, the better you will get. Now, when I was at high school, I did music in year 7 and 8, and I was a lousy student in music. I did terribly at it. I didn't understand it. And the reason for that was I just wasn't interested. I didn't do any work. I didn't practice playing the recorder. That's the musical instrument we had. And so therefore, I never did very well in that subject. If you don't practice the debits and credits, you're not going to do well in this subject. So the more you practice it, the more you do it, the better you're going to be in this subject. So let's now have a look at T accounts. What are T accounts? Well, basically T accounts are what you can see here for the cash account. Every single account has a T account. Now, I want you to do another thing for me. I would like you to get another piece of paper and write out an example of a T account on that piece of paper, right? So basically, I want you to write the T account, and I want you to write account name at the top, because every single account has a T account, so you have the account name at the top, and I want you to write debits and credits, okay? So the debits are on the left side of the T account, right? So this side is debit. Credits are on the right-hand side of the T account. So I want you to make sure that you write credit on that side. So there we go. Debits on the left, credits are on the right. So make sure that you write that on a piece of paper, because this is, again, something that we're going to refer to throughout today's class and in the following weeks. Have you done that? Now, for the T account that you just drew on your piece of paper, regardless of the type of account, whether it's a cash account, so an asset account, or a liability account, or an equity account, the debits are always on the left-hand side, the credits are always on the right-hand side. That is the convention. So, as I said before, when we looked at the accounting equation, we had this piece of paper here, right? So that piece of paper is where you wrote out your accounting equation, and you had on that accounting equation, assets equals liabilities plus equity, right? So debits increases assets, credits increase liabilities and equity. Now, if you look at cash, which is an asset account, then any increase in cash appears on the debit side, because that's increasing the cash account, and any decrease where we take cash out of the cash account appears on the credit side, which is the left-hand side of the account. Okay? So the normal balance of an account relates to the side of the account that balance is normally on. So in an asset account like cash, the balance will always be on the debit side. It can never be on the credit side. So let me give you an example. Here's $50, right? Now, if I have $50 in my wallet, I can either have $50, I can have $40, I can have $2, $1, I can have $0, but I can never have any less than $0. So therefore, the balance of this asset account always has to be on the debit side only. Okay? The lowest balance it can obviously have is 0, but it can never enter the credit side. So when we look at these T accounts here, if we shift and move on to liabilities. Now, in the liabilities account, you either have a liability or you have no liability. Now, as I said, when I showed you this particular accounting equation, assets equals liabilities plus equity, I said that to increase liabilities, we debit those accounts. So any increase to a liability account, for example, accounts payable, will enter the debit side of that particular T account, right? So if we agree to pay a supplier $75 for an item purchased, we credit that to the liability account. When we repay a liability, so we pay back the supplier, $25 in this case, we decrease that liability account by debiting that account by $25. Now, what is the balance of this particular T account? Think about it. What is the balance of this T account? If we incurred a $75 liability and we paid back $25 of liabilities, what would our balance be at the end of the period? Okay, so our balance would be $50. So 75 here minus the 25 here, giving you a balance of $50 at the end of the period. Now, this is just an example of two transactions entering the accounts payable. There may be others, and we would need to consolidate those together to generate the final balance, and we'll look at doing that in more detail as we move through this workshop. So that's all I want to show you in relation to T accounts at this stage. I want you to remember that the debits are on the left, the credits are on the right, and for asset accounts, you increase through debiting, you decrease through crediting, and for the liability accounts, the debits and credits are still on the same side, but to increase your liabilities, you obviously credit. To decrease your liabilities, you debit. Now, remember that we looked at normal balances for the asset accounts, and the normal balance of an asset account was the debit side because you increase an asset and you can't decrease an asset any more than the balance is on the debit side. The same principle applies for liabilities. You either have a liability or you don't have a liability, right? So if we take out a $75 loan, we can only decrease this account by up to $75, right? We can't pay off any more of the liability than what exists on the credit side of that T account. Now, moving on, some trivia. So you will notice that if you look at a bank statement, here's an example of a bank statement that I've found randomly online. In this particular case, it says that the account holder has an ending balance of $5,684.22. Now, what I want to focus on is two different columns here. We have the debits column and we have the credits column. Now, the bank is reporting the movements in this account holder's account over the period this relates to. Now, what you can see here is that when the account holder's account is decreasing in value, right, the bank is showing this as a debit, right? So you can see that debiting down here is progressively decreasing this balance down here. Now, when the account holder deposits an amount in the account, they are crediting this amount. So the bank is crediting that amount of $653.25, which increases the account balance from $3,306 to $3,959. So in this particular case, why is the bank showing an increase in the account balance as a credit? Well, the logic here is that the bank is showing you their version of accounts. So when you deposit money into a bank account, $50, $100, you'll pay for the period, the bank credits your account. The bank owes you this money. So essentially the bank is showing you the liability they have for the money they owe you, right? So they're giving you their version of accounts, right? They owe you whatever your account balance is. So that is therefore a current liability which has a credit balance. Now, when you go to the bank and you take $50 out of the account, then the bank obviously pays you that $50 and they no longer owe that to you. So they are reducing their liability. And as we saw with the T account in the previous slide, if we reduce a liability, we debit that account. So that's why when you take money out of your account, the bank is showing it as a debit.